Hello everyone, welcome back to Cabbage Financial Solutions. My name is Mashkur Ali. Today, in this video, we will clear up the confusion for veterans who are wondering whether the 90-day flip rule applies to VA loans or not. Before applying for a VA loan, it is essential to know all its rules and terms to avoid any issues with the approval process. The 90 days rule applies to VA loans, but the 90-day flip rule does not. This is the main reason many veterans are confused about whether the flip rule applies to VA loans. In this detailed video, we will discuss the differences between these two rules and explain why those who think both rules are the same are mistaken. So, let's get started. To understand whether the 90-day flip rule applies to VA loans, we've brought you to this website called Cabbage Loan Guide. This website contains numerous articles related to banking. One of these articles is titled, "Does VA Loans Have a 90-Day Flip Rule? Every Veteran Should Know." When we scroll down in the article, it explains what the 90-day flip rule is. It states, the 90-day flip rule is a regulation primarily associated with FHA loans. This rule requires that a seller must own a property for at least 90 days before selling it to a buyer who plans to use an FHA loan. The 90-day countdown begins from the date the seller takes possession of the property and ends when they enter into a contract with a new buyer. Scrolling further, we find a subheading, "Does VA loans have a 90-day flip rule?" This section explains both the 90 days rule and the 90-day flip rule. The article clarifies that the 90 days rule applies to VA loans, and this is why people often confuse it with the 90-day flip rule. However, the truth is that the 90 days rule applies to VA loans, but the 90-day flip rule does not. Now, let's understand the difference between these two rules as explained in the article. One is the 90-day flip rule, and another is the 90 days rule. For your information, let us tell you that both are completely different from each other. 90 days rule. The 90 days rule means that whenever a military member applies for a VA loan, their job must be at least 90 days old. Only then can they apply for the loan. This is known as the 90 days rule. 90-day flip rule. The 90-day flip rule is often associated with the FHA loans. It means that any seller must wait at least 90 days before reselling their property, which is known as the 90-day flip rule. So the answer is that the 90-day flip rule does not apply to VA loans. However, there is a 90 days rule for veterans to be eligible for a VA loan. This means veterans must have at least 90 days of continuous active duty service to qualify for the loan. The article also provides links to the sources of this information. You can visit the website to read the article in detail and check the links for additional verification. The link to the article will be available in the description. So, friends, this is how we learn that the 90-day flip rule does not apply to VA loans, but the 90 days rule does. These two rules are entirely different. If you found this video helpful, give it a thumbs up and share it with your friends. Don't forget to subscribe to Cabbage Financial Solutions for more tips related to lending and banking. Thanks for watching, and I'll see you in the next video.